All right, future CPAs, let's talk about one of the heavy hitters for the board exam, depreciation and wasting assets. I know, it's a topic that can feel like hitting a brick wall. But trust me, we're going to break down that wall brick by brick. By the end of this, you'll have a solid mental toolkit to crush these problems and turn this tough topic into easy points. Let's get into it.
Okay, first things first, let's get our brains warmed up with a real-world scenario. Let's say a business buys a brand new van. A whole year goes by, is running like a dream, no problems at all. But when you look at the company's books, its value has dropped. Why? It's not magic, it's not a mystery, it's accounting. And the answer to this question is the key to everything we're about to cover.
And that key is depreciation. Now, the textbook definition is the systematic allocation of an asset's cost over its useful life. Okay, what does that actually mean? Look, it's not about guessing what you could sell the van for today. That's market value, totally different thing. Depreciation is all about spreading the original cost of that van across all the years it's helping you make money. It's all about the matching principle, matching the expense to the revenue it helps generate. That's the entire game right there.
So how exactly do we spread out that cost? Well, you've got options. Think of it like a toolkit. You wouldn't use a hammer to turn a screw, right? Same idea here. There are 4 core methods, and knowing which tool to use for which job is exactly what they'll test you on in the LECPA. So let's open up our toolkit. Here's a quick bird's eye view of our 4 main tools. You've got straight line, the simple, reliable one where the expense is the same every year. Then there's units of production. This one's all about usage. After that, we have the 2 accelerated methods, sum of the year's digits and double declining balance. These are for assets that are super productive when they're brand new, so they have a higher expense up front. We're going to dive into each one now.
First up, the workhorse, the straight line method. It is by far the most common because it's just so simple and makes a lot of sense. You just take the cost, subtract what you think you can sell it for at the end, that's the salvage value, and divide by how many years you'll use it. Boom. You get the exact same depreciation expense year after year. Super predictable, perfect for things like office furniture or a building.
But what about an asset whose life is more about how much you use it, not just how much time passes? Like a machine in a factory that makes thousands of items, or maybe a delivery truck that racks up kilometers. That's where units of production comes in. With this method, the depreciation expense goes up and down with the asset's usage. A super busy year means a high expense, a slow year means a low one. It's the ultimate example of the matching principle in action.
Now let's talk about the fast and furious methods, the accelerated ones. These are perfect for things that lose their value super fast, like technology. Just look at this chart. In the very first year, the expense from double declining balance is way higher than good old straight line. Sum of the year's digits does a similar thing. The whole point is to front-load the expense to match the fact that the asset is most valuable and useful when it's brand new.
Okay, so you've got the methods down. You're feeling good. But you know the LECPA loves to throw a curveball, and one of their favorites is the change in accounting estimate. What do you do when you're 3 years in and you suddenly realize, hey, this machine is going to last way longer than I thought? Let's nail this down, because you're going to see it.
And here's the thing, this isn't just something you can do, it's something you have to do. The rules, specifically IAS 16, say that at the end of every single year, you must review your estimates for useful life and residual value. If reality has changed, your accounting has to change with it.
Okay, listen up, because this is the absolute golden rule. If you remember one thing from this section, make it this. Changes in estimates are applied prospectively. That's a fancy word that just means from this point forward. You do not, I repeat, do not go back and change the depreciation from previous years. No time machines in accounting. What's done is done. You just fix it for the current year and all the future years.
So how do we actually do the math? Don't worry, it's a simple 3-step process. Step 1, figure out the asset's current book value or carrying amount on the day you make the change. That's just the original cost minus all the depreciation you've already taken. Step 2, take that number and subtract the new salvage value. And finally, step 3, divide that result by the new remaining useful life. That number is your new annual depreciation from now on. Easy.
All right, let's totally switch gears. We've been talking about things we build, like vans and machines. But what about things we take from the earth? Natural resources like coal mines, oil reserves, or timber forests. For these wasting assets, we don't use depreciation, we use its rugged cousin, depletion. And this is super important, especially in the context of the Philippine mining industry.
Here's the simple breakdown. You depreciate things you build. You deplete things you pull from the ground. Depreciation is usually tied to time or how much you use something. But depletion, it is all about one thing and one thing only: how much of the resource you have physically extracted.
So to calculate depletion, we first need to figure out the total cost, which we call the depletable base. And it's not just the price you paid for the land. You start there with the acquisition cost, but then you add in all the money you spent to find the resource. That's exploration costs. Then you add the costs to get it ready for digging, like building tunnels. Those are development costs. And finally, you even add the estimated cost to clean up the site when you're done.
Now, once you have that total depletable base, you calculate the depletion rate. And hey, this formula should look really familiar. It's basically the exact same logic as the units of production method. You take your total cost, subtract any salvage value, and divide by the total number of units you think you can get out, like barrels of oil or tons of coal. This gives you your cost per unit.
Okay, team. Deep breaths. We have covered a ton of ground. So now it's time for the final power-up. This is your rapid-fire ultimate cheat sheet for the exam. Get your phones ready to screenshot because we are about to drop some serious knowledge bombs that will translate directly into points. This right here is the money slide, your formula master list. Straight line and units of production are pretty straightforward. For some of the year's digits, just remember to calculate the SYD denominator first. For a 5-year life, it's 5 plus 4 plus 3 plus 2 plus 1. And the big trap for double declining? Remember you use the book value. Costs minus accumulated depreciation, and you initially ignore the salvage value in that part of the calculation. Seriously, screenshot this, tattoo it on your brain. These are free points.
And now for the pro-level study hacks and exam traps. First, if they mention use instead of time, your brain should immediately scream units of production. Second, a change in method is treated just like a change in estimate, prospectively. Here's a huge one. Depletion expense is based on units sold, not just extracted. They love to test that. And finally, for that bulldozer at the mine, if it's useless after the mine is empty, you depreciate it over its life or the mine's life, whichever is shorter. Got it?
So we've gone through it all. To really make this knowledge stick, I want you to think about something you use every day, your smartphone or your laptop. Which one of these methods do you think best captures how it loses its value? Is it a slow, steady burn or a massive drop right at the beginning? Connecting these concepts to your own life is the ultimate study hack for making it stick. You've got this, future CPAs. Now go crush that exam.